they're spinning. There we go. Okay, now we can officially start this. It is April 4th, if you can believe it. Time flies whether you're having fun or not. I have learned as I've gotten old. Barry Bailey, nice to see you too. And this is the Edge live demo and discussion. And I've got three core things to talk about. We try to hit the basics, return to them, and without repeating ourselves too much, but it's helpful. And then we'll hopefully cover some deeper nuances too. It's less here we'll walk you through the ABCs and more almost like a users group discussion. Can vary at times, but that's the plan here. So what I want to do is I want to talk about these, go back to the telltale signs that we could have some trouble. I mean, the market today, it's reflective of these conditions that are observable in the data. But look, I don't catch them every time either. I mean, sometimes you're just too close to the forest to see the trees. But I'll show you what I mean. And let me share my desktop here. I do want to talk, and Brian, you did this, I think, last week, talk a little bit about broad context, the broad rules, BCD. We say, always think about what the big picture is, broad market sentiment, because the market is dominated by passive investment, and it follows models, and it moves in measurable fashion. And so that's broad market sentiment, the B. Then we say context. What is occurring in the market on the macroeconomic calendar? Is it earnings season? These are things that can alter the math of supply and demand, and you need to know that they're there because they reduce the probability of outcomes. And then we trade divergences: long divergence, short convergence. And for those of you who joined the Interactive Brokers discussion today, what the section you saw is in here. This is daily trading ideas. The advantage of the whole platform is we can see all of the money on the platform. There are those same momentum and low volatility portfolios that we discussed. If you look at them through here, you're going to see those probabilities. I'll come back to that. Then you can build any kind of portfolio you want. I have a mega caps portfolio here because I just want to know what's the biggest stuff in the market doing. These 112 stocks, believe it or not, if you do the math, they are close to 75% of market cap. Do the math on the S&P 500, that's 88% of market cap. Let me let that individual in. So I find that helpful. And here's what it looks like. So it's very simple. If you create a portfolio, my only criteria is that market cap is equal to mega cap, which is greater than 100 billion in market cap. It's just nice to know, right? It's not a necessary thing, but you can very easily build one of those if you want. You just go over here and you create a dynamic portfolio. You look at the filter and you go to market cap, and you say equals mega cap. That's it. So it's very easy to do.
Not only is that not a crime.
Let's see. Somebody's not muted. If you could mute yourself, that'd be helpful. Then we put a bunch of portfolios out here for you. All the sector portfolios are there. So we license GICS data from the S&P 500 so that we can do that, S&P Global, sorry. And it gives you the ability to see what all of the money is doing. And so it's a good lead in to what I want to talk about first here, which is making sure that we're aware of the telltale signs of things that may happen. And broad sentiment will do that most of the time for us. It's a good broad read, but that's not perfect. Here, for instance, I pointed out how healthcare, if you look at healthcare, and healthcare was, there was news about Medicare payments that hit United Health. News can have an effect, no question. Speculative trading occurs. News can change the value of options, the derivatives associated with a stock, and they can be immediately marked to market. And they're 20% of market cap. Well, that can be, can have a big effect. But if you looked at the healthcare sector, what you would see is that it's among the almost hard to find anything quite like it. It had rapidly rising supply and flat demand. In fact, if you ran a trend line, demand would be trending down, supply trending up. Well, that's an indicator. When those things are happening, probably you don't want to own healthcare. And it's not that that's the only thing. You look at tech, it's fine, but as Brian Wilson noted today, but the demand has peaked and is beginning to decline in tech. Tech is a very large part of the market. Call it more than a third of the S&P 500. You add up tech and communication services, tech that is in consumer discretionary, you got over half of the market is dependent on the trends in tech. It looks generally fine, but because the supply side's trending down too. But that's not the kind of market that gives you momentum. And look what the market did. Nice beginning to the day, not so good now. I don't know what's going to happen. Maybe the market finishes fine. But it's a reflection of the fact that there aren't good divergences. Divergences are necessary for momentum to work. And so you can see that. There's a key point I want to give you here in just a little bit. But that's also what you see if you just look at the components in low volatility and momentum. The total of 38 is a big number. Really, that's not bad. I mean, there are times when none show up in those portfolios, as those of you who have used the platform for quite a while know. But when it's more than 2 to 1, almost 3 to 1 here, low volatility, it tells you that this is the better trade. And low volatility probably is doing just fine today. I haven't looked through it, but it's probably the case. You look at AbbVie, AbbVie's under pressure. So you can look by portfolio or stock. I'm going to switch here. But earlier it was down all of its volatility. You look at that and say, would I buy that? Well, maybe, yeah. I mean, this created the problem. The uptrend in supply. There were right here at March expirations, but this was everywhere. There were short bets. So people bet short. Well, what's that bet on? And then stock went up, but now it has reverted. So did people make money on that trade? Maybe, right? Probably so today. So then you look at it and there's short volumes coming down, and yet the demand side is 5 all the way across. It's because AbbVie is a low volatility, large cap value stock. It should be at 5. Well, you look at that and say, there's probably opportunity to make money, at least 1%. Doesn't have to rise much for you to make money on that trade, looking at the supply-demand balance. So here's what I want to point out. As I looked back on this, it's been kind of a tough week for stocks overall. I think the worst week of the year for the Dow, blue chips. Here's the thing that stands out. Let's just go look at the portfolios. You can see it here in momentum. Come down and look at the supply side. Worst part of the supply side coin was right here around options expirations. And they're roughly the third week. It's not one day, it's a number of days. And there were big index rebalances here. So you have high supply, it has come down since. Come over to low volatility. Highest point was a little bit earlier, but it still rose above trend right around options expirations. Clearly not, people weren't shorting low volatility. It wasn't anything like back here, but there's that movement. Come over to mega caps, same thing. There's that bump on the supply side. You're not going to see it in short volume or stocks to short. Airlines and cruise ships, just a portfolio I created, same thing. Big tech, same thing. AIs actually came a little bit later, but there was a little bump up there. Crypto stocks, same thing. There was a little weakness that followed for Bitcoin. If you looked at Bitcoin now, you should note this. Once demand begins to tail off in the stocks, there could be a consequent effect on Bitcoin. If the supply side rises, then it could come down meaningfully. I don't see this as a big issue, but it tells you that the probability of going back over 70,000 in the next number of days probably is limited because of that data. But here's the thing, look at financials. Look at that. There was a radical shorting of financials that occurred at March expirations and with index rebalances. Look at financials overall. Is that an indication that there is money betting that there's going to be additional trouble for financials? Well, I can't say absolutely, but those patterns are just kind of crazy. It's very interesting. Look at industrials, same pattern. Tech, same pattern. Insurance, just a subset that we look at. I mean, same pattern. Materials, massive short at March options expirations. We're getting to the end here. Real estate, little bump, not as bad. Semiconductors, don't see that, interestingly. It's not there in those. Utilities wraps up all of the sectors. Not as bad here, but it's again, the high water point was right around, the 16th, 17th, 18th, 19th, 20th. They're in that range. And there it is. So that money, that short, it doesn't always manifest right away, but it's an interesting thing to note. So certainly we want to look at that as we get to April options expirations. Won't be a quarterly rebalance. It won't be the quad witch. It'll be a triple witch. But I think that's very telltale. And did I notice that? No, I didn't notice it as, certainly we talked about, short volumes, now it's back down. But we didn't step away from the forest long enough to say, wow, that is really interesting that that's occurring. But to me, what that meant, if all the global macro money shifts short and there isn't as much money flowing, clearly there was not a surge on the demand side at index rebalances, maybe not as much money going to equities and more short, what's likely to happen? And when will it happen? Can't always say. I mean, you look at broad sentiment, and I'll look at that next in the point, and then I want to go to a couple more examples. It can take a little while, but I submit that that behind the scenes, people had already decided at March expirations that the Fed, if it's a monetary policy thing, was not going to be as quick to cut rates as everybody thought. They had already made that determination. There was already a determination to reduce flows to the equity market. Now, what will be the overall consequences? I don't know. And Brian and I will both talk about what's ahead. But going to the big picture, this is the other, there's context, what's going on around us. And then the first thing here, broad sentiment. Always want to look at this. The market trades between 4 and 6 most of the time. If I back this up, let's just do a 1-year look. It's a very good read on what's likely to happen. When the green part of the graph drops below 4, that green line, almost always the market rises. Could be very short term, as it was back here in August. There was general weakness in the market, but every time it drops below that green line, it can be very long lasting, as it has been since back here at the end of October. It could be very short term, but it's a very good indication of a market bottom. And Brian's going to talk about the red line, so I'll leave that there. That's the other side of the coin. I'll let him pick that piece of the puzzle up. But you always want to know, what is the overall supply-demand balance? Is there good demand, or is demand flagging? Are there supply deficiencies, as there were here in November and December, that helped propel a very strong run for the market? They're still there. Here's that very same thing that we saw all over the market. It's in broad sentiment too. It's in the S&P 500 too, where this is the high watermark right during March expirations. Short bets, have all those been covered? I don't know if they've all been covered. It's getting close. But that's what causes problems for the market. Once those cover, I know what happens next. I don't know. We'll come around to that, but you clearly want to know the relationship between supply and demand in the broad market, because you can't, we used to say you can't fight the tape, can't fight the Fed, and you can't fight the larger, almost lava flows of the market. Renaissance Technologies has people who applied principles of geographic formation to their trading schemes. And we don't know precisely what those look like, but I suspect they're a lot like this: supply and demand, where you're looking at the overall supply-demand relationships and figuring out where to be. I look at this and say the market isn't about to fall apart, but it can change fairly quickly. We'll find out, and we'll talk more about that. Okay, so the last thing that I want to cover, just a couple more examples over here. I'm going to go back to this, over to daily trading ideas and the basic mechanics. You folks who were on the Interactive Brokers discussion already saw this. Repetition is a good form of reinforcement and emphasis, so I'm going to do this again. So I'm using these. This is it speeds it up for me. It is not a great momentum market right now. Certainly there were things that did very well. I mean, you could have made multiple percents today. You had to get into MicroStrategy very early in the day because it very rapidly left the entry range. And if that happens, it's not worth chasing, because you might buy and it's out of this range, and then all of a sudden the market does exactly what it did. It turns on you. So to avoid that, I mean, the best thing is don't buy something if it's already outside the range. You can have another opportunity. There is always something else to trade, and it doesn't matter what the price is. What matters is you have a high probability of a return. And so that's what you really want to look at. I mean, it's very good data here. It's at 10, and supply has trended down and continues to, what we look for is a day over day and a 5-day decline on the supply side. The Hicks rule is something hits 10 and the supply side drops, very high probability of producing a return. Let's see, I think I mentioned this one, Kinross Gold. It's a lower price stock, but there's a great divergence. Rising, it's not all the way to 10, falling supply. Those are the things you want to look for. If I go back to the probabilities, it's in there today. And we sort by entry. I like that. You can just very quickly sort by entry price. The default is volatility because we're trading momentum for more potential low risk, high probability return. It trades, it's a less than sub $10 stocks, greater standard deviation, greater risk. But I mean, it offers a good opportunity, and I think it's in that range today. What's the probability, depending on what the jobs data are tomorrow? Context. Jobs data can rock the market, could lift the market. I don't know what it's going to do. I look at the data and think the market has a propensity to rise and then mean revert. Same thing might happen tomorrow, and that's because supply and demand in the broad market are just about level. There's not anything giving the market a good direction, but that stuff works, and it takes a lot of the work out of it for you. But finishing this thought, right now, Brian and I both agree, you're better off to be in low volatility because that's where the money is. The opportunity for gains is smaller, 1% instead of 2%, but the risk is also lower. You can get hurt very quickly in momentum stocks, which can give up all their momentum, and suddenly you're down 3-4% if you don't have your a stop or a limit in. So it's just important to know. I again like to do this. You could look at lower entry prices because why that is it doesn't take much of a move. If you bought Comcast between, call it 41.20 and 41.70, you don't need it to go up very much. It gets to 42 and you've already made your money easily. Well, that's kind of nice because that money that kind of movement of 1.7%, the market can tolerate. And so it gives you a chance to do that. Okay, so that's just revisiting mechanics. I will stop there, and at the end, Brian and I can talk about what's ahead. Any questions, comments, thoughts, observations, heckling, jeering? You can do any of it. Okay, then Brian Wilson, I'll hand it over to you for the better half. Let's see. There, Etta, you have a question. Mike, let's see. Let me answer some of these questions, right? Okay, Brian, you got that one? Okay, or did you get all these, Brian? You got them? Okay. Etta, does anyone use the daily trading ideas, whether momentum or low volatility, to optimize? Call, yes. Yeah, absolutely you can. I mentioned that on the Interactive Brokers discussion today, that the same principle applies. You're using supply and demand, and a call or put is merely a derivative of an underlying product. For short term, for 0 days to expiration options or weekly options, not as good because there's almost no asset movement associated with those. There's no point of going through the settlement process for an option that is that short. But for a longer window, the monthlies in particular, absolutely it works. You could buy the option instead, or if you're gonna you own stocks that have strong demand and insufficient supply, you could sell a put. If it's the reverse, you could sell a call, and in both cases you're keeping the premium with a high probability because that the prices are likely to move favorably to your desire to keep the premium. That's how I'd answer, and Brian may add to that.
And Lars, we'll probably I'll let Tim look at your question here for a moment. Maybe we can go back to that towards
Lars,
the end.
we will get to you. That's a good question.
Yeah.
Barry Norton may weigh in on that too. Barry, we'll come back to it if we can at the end. Yeah.
Absolutely. All right. Let me share my screen. Hopefully that's. Let's see.
You want us to draw on that, Brian? Just kidding.
Yeah, that's interesting. Can you see my screen right now, Tim?
I cannot. No.
You cannot. Okay. All right.
Let's see if we can get rid of that, right? Can we get rid of that? No, you're showing a whiteboard.
Let me see. Okay, is that better?
Yes. Now you're good.
Okay. Everything came up differently today. That's what happens with systems sometimes. What I wanted to share or start off with today was broad market sentiment, and Tim had mentioned this earlier. So when you
we're not seeing the app though, Brian. We're not seeing the app. No, we're seeing
the app.
Like a browser.
Okay.
You might have to share your whole screen. You might be a window. You just see.
Okay. Sorry.
Yeah.
Sorry, guys.
Nope, you're okay.
Let me try one more time. Well, Tim, I'm going to have to let you steer because I don't know what's happening with my system here.
Yeah.
But I can describe what I'm trying to point out here for you.
Okay.
If you could just go to broad market sentiment and just maybe show the window a little bit longer, perhaps over like a 6-month time frame, something like that. So what I wanted to describe with this exercise, when you see the green and red lines, the market's been in an incredible bull run here over the last 6 months or so. And we just have not been below the green line very often. You can think of the green line as oversold conditions. You can think of the red line as overbought or stretched conditions. And what I wanted to point out today, and I won't be able to show you the Excel spreadsheet, but I've got a spreadsheet going back 4 years looking at, when have we gone through the red line in the past? What has that meant for market performance? Let me just pull it up on my computer so I can tell you what's happening. So over the last four years, when you get above that red line, on average, we stay in that, let's call it stretched condition for about 10 days. And the average performance during that, let's call it 2-week window, is 70 basis points. So when I mentioned in today's note, that we're kind of coming to kind of a standstill, that's why. If you look at those broad market conditions, sentiment is above 6. There's nothing wrong with that. Short volumes are low. There's nothing wrong with that. Those are very healthy conditions for the market. But once again, when you get to that red line, unless you're in like a true momentum market, it becomes very difficult to continue to post gains. Now, if we look at last year, and I'd consider last year a bull market, when we got above the red line last year, we averaged 1.5%. So in a bull market, there are still gains to be made, but once again, that average does diminish, a lot under normal market conditions, and that average once again is right at 70 basis points. I also wanted to point out just a couple of other uses that that you can do. You can do obviously the daily trading ideas, which is fantastic. I use that every single day. You can also use Edge, and I will do this at times for market hedges. I did it recently, going from a quarter to quarter transition. Now, part of the reason that I did it, the market had just been in fuego, if I can use a Spanish term. It had just been on fire. That was part of the reason. Another part is that behind the scenes intraday volatility had just absolutely collapsed. And Tim and I had spoken into that, and Tim and I were mentioning it in our group meeting at our company Monday morning, what a phenomenon that was. And I'm like, the market's got to come down because there's just no volatility in the market right now. And sure enough, Monday and Tuesday we did see declines. So for me, I set up a market hedge at that point because of collapsing intraday volatility and because we were at that inflection point where sometimes strategies and tactics can change. We mentioned this during last Thursday's meeting, that we thought there would be declines in the market, but we didn't think they would be very long lasting. Why was that? Because you look at the setup right now, we're still great. Markets, sentiment is 6, short volumes are low. This is not a market right now that tells us that it's going to implode, but it did have characteristics where you would see these, short little blips lower. If I'm setting up a market hedge, and this is not the best instrument in the world, but I'll use it sometimes. It's a short-term instrument. I'll use UVXY. That's a volatility instrument. Other ones that you can use include SPXU, SQQQ, or SDS. And those are all different ways. They're all leveraged instruments. So just be aware of that. And then I'll kind of go into the what I see for ahead, and then Tim can mention what he sees as well. We do have a jobs report coming up tomorrow, and we're going into a little bit of I'll call it a little bit of a no man's land right now. We have a week and a half coming up until options expirations, and recognize that market strategies are very short-term oriented. They're often going from one expirations period to another, sometimes, beginning of a month to the end of a month. But that's why when Tim was talking about option strategies, it's really difficult to be predictive going out more than a month. It's almost impossible from a market structure perspective because the visibility is just so limited and the strategies can change so rapidly. We saw how they changed there at options expirations, and that can happen, just in the blink of an eye. So as we look ahead, to me, I'll call it a slow churn higher, unless we see some real changes in the data. And what I mean by a slow churn higher, 70 basis points was the average in this environment. Above that red line. That's what I mean by a slow churn higher. Up days, down days. If short volume changes dramatically, moving higher, or if sentiment really starts to weaken a lot, that forecast could change. But right now, I would say a slow churn higher.
Thank you, Brian. So Lars, let me answer your question. And Barry Norton, you can weigh in on this. So Lars asked, could you please provide the key parameters for the short candidate portfolio you mentioned based on convergence? And I should have kept sharing my screen, so bear with me. So what Barry Norton does, the Norton rule, is he inverses the momentum portfolio characteristics. So Lars, using this through Interactive Brokers, it's going to be this portfolio here, but underneath it there are the characteristics criteria that we apply to create the list that we're going to calculate probabilities for, and I'll show you those. So in the system portfolios, because this is how you could build a short portfolio. These are the criteria. I'll see if I can scroll enough so that if you want a screenshot of these, you can do it. And I'll explain what they're telling you. I think that's all of them. Okay, so what we look for is we don't want market structure sentiment that's falling, so it's not equal to that. We want very liquid stocks, and we use we call dollars per trade. You know, the average stock in the S&P 500 trades 50,000 times a day. You know, Nvidia can trade 1 million times a day. They trade a lot, but what is the size of a trade? Well, $3,000 is a pretty liquid stock, believe it or not. Most stocks don't have to trade for far less than that per trade. We want stocks you can get in and out of. We want at least one standard deviation of divergence, volatility of 3% or greater, market structure sentiment of 8 or greater, short volume less than 50%, the one-day trend down, market cap not equal to small cap because you can't get in and out of them. There's not liquidity. 5% of all assets under management are directed at the Russell 2000. So it's very difficult to get good trades out of that. So why do it? We just stick to the stuff that you can trade, volume of 1 million shares or more daily. So that then creates the set of stocks that we use. To short them, inverse it. You may keep all the liquidity characteristics, but you just do the exact opposite. Market structure not equal to up. You just go down the line and you reverse them. I run, and I think Brian's got one too. I'm going to close this. I keep a portfolio just to give me a read. I don't trade them, but I call this my 75% short portfolio, and I just look at the number and the sector. You know, so it's interesting that quants, if passive money is leading, it would tell us that global macro money is generally shorter financials. I mean, that's interesting. And the portfolio, the criteria, and then I'm going to give it to you, Barry, to add to this. I just look for stocks in the database that are at least 75% short, meaning 3/4 of the trading volume is coming from short or manufactured liquidity. So it's, you know, what would that mean? Well, if there's any drop, any diminution in demand, all that excess supply is going to pull prices down, and it gives us a read on the market. Barry, what would you say?
Yeah, so I'm similar. And Brian's got a screenshot of my momentum negative portfolio, which is you're right, is the exact opposite. I also incorporate the Hicks rule. So in Brian's negative portfolio, there's 3 stocks. In mine, there's 13. But what I do with the Hicks rule is it's got to be the highest supply, and demand has got to be coming off 10, preferably a 9, an 8, a 7, even a 6 if supply is high. But like you look at ANF, it's in both portfolios, but ANF demand is 1.8. And so even though supply is at 50.5, it shows up in my portfolio, but that's not one I'm going to touch because the parameters aren't in my favor. That one is going to fluctuate.
Yep.
So I've kind of taken the Hicks rule and kind of modified that on the negative side.
Right. So the Hicks rule says if short volume declines day over day, and what Barry's saying is he's doing the opposite. If short volume rises day over day, and you can you could create that in the portfolio. You could make that a criteria. Okay.
Right. So if I've got short volume rising, it's, you know, especially if it's over 60 and demand is an 8 or a 9 coming down, that's a great candidate to watch.
Yep. There you go. If I click through this, Lars, you know, I could sort it by the highest. I'm not sure what that. There we go. So for instance, these are pretty small stocks. You can see market cap. I mean, WAT. Maybe that's, you know, that's actually bottomed. Okay, so let's see if we can find down.
Can I add one more parameter?
Yeah, please.
The other thing is, even though the stock might have the liquidity component from the dollar trades, I also like to make sure that it has decent option chains, so that's got liquidity in the options as well.
Very good point. Brian does the same thing. So I hope. Did that just make it worse, Lars? I mean, we all weighed in, but it's coming back to supply and demand converging, right? And then you're adding some liquidity criteria to that. Okay, so I will very quickly wrap this up with, you know, my thoughts about navigating what's next. As I said in the market desk note, I think on Wednesday, that I would talk about this quickly. I am watching the supply side. I mean, we've had demand right near the red line for, I mean, since January, the end of January anyway. And that's a very long time. And we've said when this falls apart could be rough. Do we look at it right now and say it's falling apart? No, the supply side trend continues to be down. I think we're seeing some effects of this big short. But if it has the desired effect, people could cover that. But I'm really watching this. If this begins to rise, then the trouble gets worse. Falling demand, rising supply in the broad market would be a clear sign of trouble. And it's not clear in the data yet to me at all that that's going to be the case. If you backed up here, this is very telling to me. We talked about it at the time. This was a bad stretch where you had a lot of supply, insufficient demand in the broad market, and the broad market did poorly. Then we had a severe deficiency on the supply side and very strong demand as everybody recommitted to equities after monetary policy was reset. So how does this and current conditions compare? Well, these conditions still look very much like those conditions. What we don't have is this tremendous momentum where the demand measure shot up over 7. We don't have that anymore, but we don't have the supply deficiency. When that changes, and it will, I don't know what will change it. It'll be global macro money that is looking at all kinds of things, and then its behavior will manifest, and then we'll observe it, and we'll know that that's occurring. But at the moment, you look at that and say, trade low volatility, beware that options that will expire in a couple of weeks will start to hit earnings season. Those things can be disruptive. But right now, knock on something wood, the data don't indicate that the market is about to fall apart. I think it will, we certainly hope those data will tell us when and if that time comes. And that's all I've got.